The illusion of financial credibility, deconstructing the credit score game. What if the number controlling your financial life wasn't real wealth, but an algorithm rewarding your loyalty to debt? Today, we tear back the curtain on the credit score system, expose the illusion of authority it carries, and reveal how to escape the game altogether. 1. Introduction: Financial Narratives in the Age of Debt. In modern financial culture, credit scores are venerated as the gateway to prosperity. However, this metric, governed by opaque algorithms and incentivized debt behavior, reveals more about one's interaction with borrowing than one's actual financial competence. The propagation of credit score importance is not rooted in fiscal wisdom, but in marketing strategies and commercial incentives designed by institutions that benefit from perpetual indebtedness. Footnote: This section introduces the idea that credit scores reflect debt behavior more than financial health. 2. Constructing the credit score paradigm. The credit score, predominantly shaped by FICO, is calculated through factors such as debt history, 35%, current debt, 30%, length of debt, 15%, new debt, 10%, and types of debt, 10%. Noticeably absent are metrics reflecting income, savings, or financial discipline. This exclusion emphasizes the score's true function, rewarding borrowing, not wealth accumulation. Consequently, those deeply engaged in debt cycles may be scored higher than those who abstain from credit altogether. Footnote: This section outlines how credit scores prioritize debt activity over wealth metrics. 3. The psychological architecture of worthiness. The term creditworthiness subtly conditions individuals to equate their self-worth with their capacity to manage debt. Societal validation, access to goods, and even housing and employment are often contingent on this number. This psychological manipulation entrenches the credit score as a surrogate moral gauge, creating a cycle where individuals pursue borrowing merely to prove they can repay. Footnote: This section explores how credit scores are tied to personal identity and perceived social value. 4. The Wizard Behind the Curtain, a structural analogy. Drawing a parallel with the Wizard of Oz, the journey toward a high credit score mimics the yellow brick road, enticing, gilded, and ultimately deceptive. Behind the illusion of fiscal credibility lies a system designed not to liberate, but to ensnare. Many, even those with high income, fall into the cycle of loans and branded credit products in pursuit of score enhancement, unaware that their financial liberation is being mortgaged in the process. Footnote: This section uses allegory to expose the deceptive pursuit of credit score improvement. 5. The Case of a Converted Consumer. A Canadian immigrant to Silicon Valley, initially flush with capital, was advised to take on debt to establish a credit history. Despite having the cash to purchase outright, he followed the guidance to borrow, believing it essential. In retrospect, he recognized that the costs, interest, fees, and opportunity costs, outweighed any benefits and severed his participation in the credit score system, opting for debt-free living and eventual property ownership. Footnote: This section presents a first-hand account of rejecting debt dependence after internal financial reflection. 6. Deconstructing the algorithm of entrapment. The credit score algorithm remains proprietary and opaque. However, the known structure reveals a clear theme. Financial compliance is rewarded only if tied to recurring debt. This system ensures that even those who come into wealth or manage money responsibly may be rated lower than those entangled in perpetual repayment schemes. Footnote: This section critiques the design of credit algorithms as tools for engineered dependency. 7. The alternative to the score, manual underwriting. Contrary to mainstream belief, purchasing a home without a credit score is not only possible, but increasingly practiced through manual underwriting. This traditional method evaluates an individual's financial capacity through real data: employment, consistent bill payment, rent history, and savings. It revives pre-credit era lending logic, emphasizing trust over algorithms. Footnote: This section introduces manual underwriting as a viable alternative to credit-based lending. 8. Credit invisibility, risk or advantage. Roughly 26 million Americans are credit invisible. This status often raises alarms in institutional contexts, yet it simply reflects a lack of recent debt behavior. Individuals who operate debt-free are often penalized not due to risk, but because of non-participation in the credit system's revenue model. Manual underwriting and higher deposits in rental contexts serve as workarounds, revealing that invisibility may in fact signal financial discipline. Footnote: this section repositions credit invisibility as a sign of fiscal strength rather than weakness. 9. Renting without a credit score, a national inquiry. Direct inquiries to rental agencies across the U.S. confirm that credit scores are not absolute prerequisites. Where traditional scores are absent, income, employment, and deposits are sufficient. In multiple cities, from Austin to New York to Greenfield, landlords confirmed that credit invisibility often results in modest increases in deposits, but not outright denial. Footnote: this section reports empirical findings that renting without credit is both common and manageable. 10. The vehicle myth: buying and renting cars without credit. Acquiring or renting a vehicle without a credit score is not only possible, but increasingly practical. Cash purchases eliminate interest burdens and future obligations. Rental car agencies, like hotels, generally accept debit cards and cash deposits, subject to temporary holds. The myth that a credit score is essential for mobility is unsubstantiated when cash and discipline are available. Footnote: this section dismantles the myth that a credit score is required for car-related transactions. 11. The awakening, from borrower to builder. The pivotal transition occurs when individuals, like the case study subject, reject the emotional dependency on score metrics and redirect funds previously allocated to interest into asset-building accounts. Over time, this strategic redirection facilitates wealth accumulation, property ownership, and financial independence, all without a credit score. Footnote: this section illustrates how abandoning the credit game can accelerate wealth building. 12. Conclusion: the game unveiled. Credit scores, while presented as necessary instruments of financial integration, are in reality mechanisms that incentivize and monetize borrowing behavior. By stepping outside this system, through manual underwriting, cash transactions, and disciplined money management, individuals can reclaim financial sovereignty. The path to true wealth is not paved with points, but with purpose. Footnote: this section concludes by advocating a return to intentional, debt-free financial principles.